Hi, everybody. Today in 5 Minute Friday, we are going to talk about the thing that's dominating the headlines the last couple days, and that is the Fed and their dot plot. So on Wednesday, the Federal Reserve released their dot plot, which is a chart showing where each Fed official thinks that interest rates are heading. And predictably, the 24-hour news cycle spent the rest of the week and is still obsessing over whether we'll see one rate cut this year or zero rate cuts this year. And the noise around this is for Wall Street is there's a lot of dot watching going on, and they want you to believe that if the Fed doesn't cut rates exactly when predicted, that somehow your retirement's in jeopardy. And we hear this all the time. We see this every single time. But here's the thing, calm perspective on this is that a sound retirement strategy shouldn't require a specific interest rate to succeed. And while those dots on the chart always move around, your personal goals shouldn't. So whether the Fed moves in June or stays put until 2027, a cash flow plan should be designed to remain steady. So we focus on the value of the companies that you own, not the price of money set by a committee in Washington. Now, with inflation back in the headlines, I've had a lot more conversations lately around, cash and safe returns, especially with everything going on in Iran and energy prices and whatnot. And I get it, because earning 3 to 4% in a savings account or money market can feel pretty good while, especially after many years of near zero. But there's a more important question people aren't asking, and that's what is that return actually worth after inflation? See, here's where there's some math around breaking even here. The number you see on a bank statement or even your investment account is what's called the nominal return. So that's just the return that you've received dollar for dollar. But here's the thing. Let's just say you go to one of those safe accounts and you feel really good. If the bank's paying 3%, but the cost of living or CPI has gone up by 3%, then you have to calculate something called your real return. What's actually kept in purchasing power. And in that case, 3% growth, but the cost of everything has gone up, your purchasing power is increased by 0. So you're not going backwards, but you're not moving forwards either. So when we talk about risk, most people think about market volatility, the red numbers on the screen that we're seeing a lot lately. But in retirement, one of the biggest risks is much quieter. It's losing purchasing power over time. So a portfolio that feels stable today but doesn't grow can slowly fall behind a lifestyle over the next 20 or 30 years. So this is why a successful strategy around retirement often separates a portfolio into two distinct roles. So what we call an income reserve is for stability. This is safe money. So its job is simple. It's to provide reliable income and peace of mind so you don't have to sell stocks or equities during a dip. It's not designed to beat inflation. It's designed to give you more control. And then you have your growth bucket, which is your long-term protection. This is where your equities live, your stocks. Its job is to grow, outpace inflation, and give you some security that a plan still works 10, 20, or 30 years from now. So if you can understand that and have a plan that you can articulate around why you're investing the money the way you are, where your income is coming from, that can give you a whole bunch of confidence going into retirement. Now, the last thing I want to mention is retirement vision. See, most people spend decades building a financial vision for when they retire. But once that transition happens, it's easy to let that vision get blurry. because retirement's not a permanent vacation. It's a transition to a new kind of work, the work of enjoying your time and your legacy. So whether you're 5 years away from retirement or 5 years into retirement, it's worth asking, even if you've asked this before at the beginning, what is the money actually for? Because even if you had a vision 5 years ago, maybe you haven't thought about it for a while. Because you might find yourself waiting for the right time to travel or to start a project. But remember that your plan is built to fund a life, not just watch the numbers grow. So I just encourage you to not let your vision get dusty. And if you're about to retire, but you don't have a specific vision for what you want retirement to look like, now is a wonderful time to revisit that. So that's it for this week. Thanks for watching. Hope you have a great day.